Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, owner, and advisor at Family Capital Management, I'm on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook, let's get started. Hello and welcome to Her Money Revolution, the podcast where we empower women to grow their wealth by making their money work for them. I'm your host, Angela Brooks, and in today's episode, we are diving into some key investment terms that many of you have been asking about. I am so thrilled to hear how helpful this podcast has been for each of you, and I love getting all of that feedback. So please keep sending me the DMs and the emails and text messages. But one of the things that I continue to hear is you are expressing the desire to better understand the jargon around investing. So today, I'm going to break down these key investment terms. I'm going to go back to the basics. It's a great starting point. So make sure to grab a notebook, cup of coffee, get comfy, and let's break this down in a simple and actionable way. Whether you are new to investing or if you are looking to refine your current strategy, understanding these key terms will boost your confidence in making informed decisions, and it's going to help you avoid common mistakes that cost money. So let's dive in. An IRA. An individual retirement account. An IRA is a tax-advantaged investment account designed to help you save for retirement. In 2024, the contribution limit for traditional and Roth IRA is $7,000, with an additional $1,000 catch-up contribution for those of you that are 50 years and older. So you might be wondering, what's the difference between a traditional IRA and a Roth IRA? A traditional IRA is contributions may be tax deductible and your investments grow tax deferred. However, you will pay taxes when you withdraw funds in retirement. So depending on your income bracket, how much income you bring in determines if this is a tax deductible contribution. A Roth IRA are contributions that are made with after-tax dollars, but your money in a Roth IRA grows tax-free. And qualified withdrawals in retirement are also tax-free. So I love a Roth IRA. There's certain income limits there as well. If you make too much, you can't contribute directly to a Roth IRA. And there's some strategies around that. But in the next episode, I'm going to go over 2025 contribution limits, and we'll kind of dive into some of the detail and all of that. But for today's episode, I want to just focus on the terminology. But a Roth IRA is a great investment vehicle to go as aggressive as you are, maybe not even comfortable with, but put all of your aggressive options there, and because it grows tax-free. A 401k. The 401k is an employer-sponsored retirement account. In 2024, the contribution limit for a 401k is $23,000. If you're over 50, you can contribute an additional $7,500, which is a catch-up contribution. So don't forget to take advantage of employer matching if that's available for you. It's essentially free money, basically. So we want to make sure that we are contributing to a 401k to at least as much that your company is going to match. Asset allocation. This refers to how you divide your investments among different asset classes, like stocks and bonds, cash, etc. It's the foundation of your investment strategy. So why is it important? Because having the right asset allocation that aligns with your investments, with your financial goals, your time horizon, your risk tolerance, this will help manage the risk by spreading investments across different asset classes, which of each performs differently under different market conditions. Okay, so when we think about, I have clients that are asking, hey, what's a good stock? Well, what's your current allocation, asset allocation? What's your time horizon? What are your financial goals? When are you going to need this money? There's a lot that goes into understanding how to invest your funds. But I want to talk in some general terms as far as asset allocation. So again, this is in general terms, growth allocation. Okay, this is what you're going to be more aggressive. The objective with a growth allocation is to maximize growth potential over a long time horizon. So typical breakdown, you might have 80%, 80 to 90% in stocks, 10 to 20% in bonds, maybe 0 to 5% in cash or cash equivalents, like a money market. So a growth allocation is heavily weighted towards stocks, which have higher potential for return, but also come with greater volatility and risk. So you have to be able to stomach a lot of ups and a lot of downs. When you are in a moderate allocation, this is more of a balanced allocation. The goal here is to achieve balance between growth and stability. So you want some exposure to growth and equities, but you also want to maintain your principal, which is the stability. So a typical breakdown might look something like 50 to 60% in stocks or equities, 30 to 40% in bonds, and then 5 to 10% in cash or cash equivalents. The goal here, or the characteristics of a moderate balanced allocation, is the balance of risk and reward by diversifying across both growth-oriented assets like a stock and income-generating asset like bonds. The last type of allocation I want to talk through is a conservative allocation or an income-focused allocation. The objective here is to preserve capital and to generate income with minimal risk. So if you're 73 or you're 60, you're older, you're in retirement, you're at RMD age, required minimum distributions, where you're required to take money out of your IRAs or 401ks, you would be most likely in a conservative allocation or an income focus because we're taking money out of that. Now, when I work with my clients, we oftentimes have 3 different buckets, right? I have one that is focused on the income needs, so that all of that money is going to be in a conservative allocation. The next bucket is, okay, well, in 10 years, we're going to go through this conservative. So maybe that bucket is focused more on moderate or your balanced allocation. And then the third bucket is this amount of resources I may never actually need. And that's maybe for legacy planning or gifting at some point. And you may have a third bucket that is in a growth or a aggressive strategy. So just because you're taking money out of your portfolio doesn't mean that you have to be 100% conservative. Okay. But a conservative allocation, a typical breakdown there would look something like 20 to 30% in stocks and equities, 60 to 70% in bonds, and then 10 to 20% in cash or cash equivalent. So a conservative allocation is going to prioritize stability and income over growth. It's heavily weighted towards bonds and cash, which are less volatile, but offer lower returns. Asset location. This refers to the strategy of placing investments in the most tax-efficient accounts based on how those investments are taxed. The goal is to maximize after-tax returns by taking advantage of the different tax treatments in various account types. So a quick breakdown of what this would look like is taxable accounts, tax-deferred accounts, or tax-free accounts. And I'm going to dive into each of those a little bit later. But why does it matter to understand your asset location? Well, proper asset location will save you money on taxes over time and help you grow your portfolio more efficiently. Rather than focusing solely on what you invest in, it's important on where you hold those investments, and understanding the different tax consequences for each of those different types of vehicles is crucial. I have a friend, she's not even a client. I have a friend that she left her employer, so she took her 401k, which was a tax deferred account. It was the traditional 401k, and converted it to a Roth IRA, which is a tax-free account. And she didn't understand. She didn't understand the tax consequence that was going to happen, and which that was she had to pay income on the entire amount that was in her 401k. She was really upset. She didn't know. If she would have understood the asset location and how that was being taxed, the tax differences, she wouldn't have made that move. Now, okay, going forward, everything's going to grow tax-free. So that's okay. But it was like a $250,000 401k that she had to pay income on in that year. Not wise at all. Bad information from her advisor, or maybe she didn't have an advisor. I don't know. But anyway, understanding asset location is really important. Diversification. It's the principle of not putting all your eggs in one basket, okay? By spreading your investments across various asset classes and industries, you reduce the risk of a major loss if one area of your portfolio underperforms. We also want to have diversification in asset location, right? We just discussed, to maximize your tax benefits. So when I think through diversification, I also want to see a diversification among the different investment vehicles that you're in, not just the investments themselves. Compound interest. One of the most powerful forces in investing is compound interest. It's when the interest you earn starts earning interest on itself. The longer your money is invested, the more it grows. This is why starting early is so important. I just met with my business group, and if you are a business owner and if you have children, having a minor Roth IRA is an amazing investment for your kids. All of my kids have minor Roth IRAs. I show earned income for them as well. Maybe they're models on my website as a business owner, or maybe they, whatever. We can talk about that. If you have questions, DM me. I'll talk through that with you. Risk tolerance. This is the level of risk you're comfortable with in your investments. Are you more conservative and want stability, or are you willing to take on more risk for potentially higher returns? Your risk tolerance plays a key role in how you should allocate your asset. So it's really easy to say like, oh yeah, I can take growth, or I can manage the volatility. And I promise you, when it actually starts happening, the market drops. Like during COVID was a year I really learned a lot about my clients. Like, okay, who can really stomach that growth and who really actually wanted more stability. Now, what I will say is that when the market drops is not the time to change your strategy or to realize, I think I should have been conservative. We can realize it, but we're not going to do anything about it until the market recovers. Especially looking at your time horizon. Okay, is this money you're taking out right now? Well, if it is, you shouldn't have been in a growth strategy anyway. But when the market drops is not the time to change your strategy. I take note. Okay, I understand my client thought we could stomach the volatility. They can't. Their risk tolerance is different. When the market recovers, we're going to go ahead and change the strategy that they're in. But I'm not going to make that change when the market's down, right? So understanding your risk tolerance is really important. Having a financial advisor that's going to talk you through the volatility and not just take orders from you, but talk you through that emotional desire or the emotional feeling like, I can't watch my money go down anymore. That's also really important, right? I have a lot of clients that most of our conversations are about managing the emotions more than managing the investment. ETF. An ETF, or an exchange traded fund, is a type of investment fund that trades on the stock exchange, much like individual stocks. They can be bought and sold throughout the trading day at market prices, which can fluctuate based on supply and demand. An ETF generally have lower expense ratios than mutual funds because they are passively managed. So that means they aim to track a specific index rather than a person actively selecting securities, rather than having a mutual fund manager. So this reduces the management cost because there's less research and analysis involved by a person. So a mutual fund is an investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks and bonds and other types of securities. A mutual fund is managed by a professional fund manager. So the mutual funds allow investors to access a broad range of assets and benefit from the professional management, making it easier to diversify their investments. However, there's more costs associated with a mutual fund because there is a mutual fund manager. But investors buy shares in the fund, and the value of those shares fluctuates based on the performance of the underlying assets within the mutual fund. An index fund. An index fund is a type of investment fund designed to track the performance of a specific market index. like the S&P 500. It aims to replicate the returns of the index by holding the same stocks or assets in the same proportions, offering a low-cost, passive investment strategy. An index fund can be either a mutual fund that we just covered or an exchange-traded fund, an ETF. Both of those aim to track a specific market index, but they differ in how they are traded. So an index mutual fund, like a mutual fund, are bought and sold at the end of the trading day at the fund's closing price. An index ETF, just like a normal ETF, they trade on an exchange like stocks with prices fluctuating throughout the trading day. So both an index mutual fund and an index ETF offer low cost, diversified exposure to the market, but with different structures of the trading mechanisms. That was a lot. I understand it. If you have to pause me and rewind, I get it. But knowing the differences there is really necessary if you're managing your own investments. A lot of times too, because the underlying fees that you don't see with a mutual fund versus an ETF. That leads me right into the last definition I want to talk about today, which is expense ratio. So speaking of cost, the expense ratio is the annual fee that mutual funds or ETFs charge their investors. It's a percentage of your investment that goes toward the fund's operating expenses. The lower the expense ratio, the more of your money that stays invested and works for you. So bear in mind, if you are working with a financial advisor or CFP, understanding how they are paid is important, but then understanding how they manage their investments or what is their investment philosophy is also important, because there's expense ratios with each of the different types of investments that your financial advisor chooses to invest you in. Okay. They don't get, depends on the pay structure. They may get paid if they pick certain mutual funds. They may have a commission that's tied to that, but understanding the expense ratio is really important. So next, I want to talk about common investment mistakes to avoid. Now that we've gone over key terms, let's quickly talk about some common mistakes investors make and how you can avoid them. Number one, not contributing enough to maximize employer match. I mentioned this earlier. Don't leave money on the table, guys. Understand how much does my employer match in my 401k plan, and make sure you're putting enough money in to get that match. So if your employer offers that in your 401k, contribute enough to get the full match. It's essentially free money. You're leaving money on the table if you don't. Number two, letting fees eat away at returns. So again, be mindful of high fees, particularly in mutual funds. So opt for low-cost index funds or ETFs whenever possible to keep more of your money working for you. You might hear me say index and chill. I love a good ETF index. Number three, ignoring asset allocation. It's easy to get caught up in trying to pick the right stocks or time the market, but maintaining a balanced asset allocation is key to long-term success. Next, I want to talk about a few strategies to consider as you build your financial foundation. This is just to remind us, this podcast, since July, I've kind of written to each of these areas in a lot of depth. But as we start thinking about 2025, I want to kind of go back to the basics and say, okay, what are some key things to start thinking about? And number one, start early. The sooner you start investing, the more time your money has to grow. Thanks to compound interest, even small contributions can add up significantly over time. I have clients ask me, how much should I be putting in? Well, how much can you afford? What's your cash flow allow? But if it's $50 a month, okay, just start. When should you start? Today. Number two, stay consistent. Consistent investing is key. If you are able, set up automatic contributions to your investment accounts so that you're always paying yourself first. You hear me say that all the time. Pay yourself first, no matter the market condition, right? So oftentimes your 401k might perform better than an IRA or a Roth IRA because it's out of sight, out of mind. It's coming right out of your paycheck automatically, bi-weekly or whatever your pay cycle is. And you're investing that. That's dollar cost averaging, right? So you're buying positions in the market every 2 weeks versus an IRA. Oftentimes you don't think about doing that, setting something up automatically and consistently. So at the end of the year, or maybe when you get your tax return back, you're like, okay, I got a chunk of change. Let me go ahead and put $2,000 or $6,000 or whatever it may be into my IRA. Well, that's one lump sum at a time, which isn't horrible, but hopefully then your advisor is saying, hey, let's see what's going on and maybe set up that $6,000 in your IRA. But I'm going to set up a dollar cost averaging strategy to say every month I'm going to put $100 into a position as an example. Okay. But I'd rather see you say, I'm going to take $200 a month or $500 a month and set that up automatically into your IRA. And then number 3, to build a solid financial foundation, you want to review and rebalance. Over time, your portfolio may drift from its original asset allocation due to market changes. It's important to review and rebalance periodically to ensure your investments still align with your goals and risk tolerance. Okay, so if you're working with an advisor, ask them how often do you rebalance the portfolios. We rebalance twice a year, in the beginning of the year, February-ish, and then towards August-ish. Now, if you are invested in a taxable account, that rebalance could trigger a tax event for you or realize a capital gain or a capital loss. So that's when we want to think about tax harvesting, which is another term. But those are some strategies that you should be working with your advisor or be mindful of when you do a rebalance. Understanding these core investment terms is the first step towards taking control of your financial future. The more you educate yourself, the more you keep listening to Her Money Revolution, the more confident you will feel when making important financial decisions. Remember, investing doesn't have to be intimidating. It is my goal to take away the intimidation or the fear around investing. It's all about building a strong foundation, staying informed, and playing the long game if you have time to do that. Like I said earlier, in our next episode, I'm going to dive into the 2025 contribution limits and what they mean for your financial strategy. So stay tuned for that. I'm excited to cover that. If you have questions about the 2024, because we still have time to make contributions for this year, so make sure you're maxing out your 401k. Make sure you're putting money into your IRAs if you have them. HSAs, all of those things are, the deadlines, the time's coming up to make sure we contribute for 2024. But tune in next in 2 weeks for the 2025 contribution limit. Thank you for joining me on Her Money Revolution. If you found this podcast helpful, please share it with your friends and subscribe to the podcast so you never miss an episode. Together, ladies, gentlemen, if you're listening, we are building a brighter financial future one step at a time. Until next time, I'm Angela, and this is Her Money Revolution. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform, and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.